All right, welcome to another Finance Friday. Once again, coming to you guys live. We do these every single week with the new studio setup here. As you can see, I've got my Wealth Dynamics memorabilia, my hats, my books, all that stuff, my J mug, feeling like home. If you guys have never tuned in before, this is something we do every single week. Okay, and the reason being is, I didn't grow up with education on finance, right? So when I started learning about money, it was something that, hang on, let me fix something real quick. There we go. It was something that I had to really figure out for myself. And so as I started learning it, I realized, man, most people aren't going to figure this out themselves. Most people are not going to take the time to learn this stuff, to get this figured out. And it took me a lot. And I was securities licensed, I was life insurance licensed. And so as I started learning it, one of my goals was, hey, I'm going to make sure that other people can learn this too. And I'm going to blaze the trail and I'm going to share the information that I've learned, right? Now, tonight's course is about the 4 different levels of investing. Okay, there are 4 of them. We're talking about the qualified investor. We're talking about the sophisticated investor, the accredited investor, and something called a qualified purchaser. These are just going to sound like words for right now, but these are 4 different levels to investing that I didn't know about. Right. I was a financial advisor. I was teaching people about investing. I was telling people how to grow their retirement accounts, how to put money in 401ks, Roth IRAs, all that great stuff. But I didn't even realize that this was a thing. Right. So I'm going to define these tonight, but I'm also going to share them with you so that you're able to understand what they are. And then you're able to get there and achieve these different landmarks for yourself, because this is something everyone can and should do. Even the qualified purchaser, which I'm going to cover as the very last one, $5 million in assets with your corporation or your trust. I think anyone can get there. Right. But the reason why most people don't get there is a lack of knowledge, which most people don't even realize these are things, right? There are 4 different, levels of investing. Most people don't even have that. The second thing is behavior, right? The right behavior gets you from one quadrant to the next. And so if I don't understand the knowledge and the behavior and actually duplicate that in my life, I'm not going to get there. Okay. So let me kind of preface this before we dive into this. This is going to be a little bit maybe technical. And so if I go over any words that don't make sense to you, concepts that don't make sense to you, I'm going to do my best to sketch it out on my trusty whiteboard here. But I want to make sure you guys stop, ask questions, comment. I value your feedback. And so I want to make sure that we're covering things and everyone understands what we're going over. Now, the second thing I want to cover is this is not the retail realm of investing. Okay. So some of you may be watching and you're like, well, I've got a 401k and I've got a retirement plan. How come I've never heard of these? Or I'm a real estate agent or I'm a financial advisor. How come I've never heard of these? Now, the reason why, and this is a term that I've coined, the reason why someone may not have heard of these is something called financial consumerism. Okay. Financial consumerism. Financial consumerism means that I buy products and services in the financial world as a consumer. Okay, not as an investor, not as somebody that's in the know, not as somebody that understands money, as a consumer. No different than somebody that consumes credit cards, no different than somebody that consumes cars or homes or mortgages. A consumer is a consumer. I'm going to change my pen to make this a little easier on the eyes for you guys. A consumer is a consumer, right? And so when I'm talking about being a financial consumer, I'm saying if I am the 401k investor, if I'm the IRA investor, I'm actually just buying products and services. So a lot of the stuff that we're used to is, built in a boardroom. It's built with executives and CEOs, and they put together, what do the people want? What do the people need? What will they pay for? And what can earn us the most in fees and commissions? And then they aggressively market that. That's not investing. Okay. So there's an entire industry of mutual funds and stocks and bonds and annuities. There's an entire industry of get your very first fourplex with 3% down. There's an entire industry of index life insurance. That is, in my opinion, all financial consumerism. And so that's not what we're talking about tonight. We're talking about, what do the wealthy actually do? What do the people that are in the boardrooms of these banks and Wall Street firms put their own money into? Okay. Because here's a stat. Okay, JP Morgan Chase, JP Morgan, gigantic bank. This is the largest bank in the United States. They have 700 million ounces of silver right now. 700 million ounces of silver. Okay, that might sound random to you, but let me spin it to you this way. Their product is selling you cash. They sell you cash for a living. They sell you cash-based products for a living, savings accounts, checking accounts, money markets, transfers, deposits, all of this. Yet they own 700 million ounces of silver. Why is that? Why would they sell one thing and own something separate? Because they're not consuming their own stuff. Okay. And this not to sound, maybe insensitive, but if you think about like drugs, every drug dealer in the world knows you don't sample your own goods. I'm not into any of that, but I'm saying it's no different. They know that to get other people, the middle class of America, hooked on their financial products and services, they've got to be really good services, and they're not for the boardroom. They're not for the CEOs. They're not for the executives. They're for mom and dad with kids and a mortgage and a house that are trying to retire at 60. Okay. So this is a totally different realm of products. Now, when I look at this, the first thing that I want to go over is I want to go over the end purpose and goal here, right? So the main goal is financial freedom. Financial freedom. That's what all of us should be going for. That's what all of us should be focused on. And financial freedom means that I have passive income that exceeds my savings, expenses, and taxes. And that's a degree of financial freedom. And so if you think about this, we have financial freedom, we have lesser degrees of financial freedom, and then we have greater, right? And so the greater degrees of financial freedom is going to be like on this side, passive income greater than savings, expenses, and taxes. That's going to be a greater degree of financial freedom. A lesser degree would be paycheck to paycheck, right? Or in debt, right? Or homeless. These would be like lower existences of financial freedom. And so someone that's further to the left side of the scale has less financial freedom. Someone that's further to the right side of the scale has more financial freedom. And the reason why I cover this first is on these 4 different levels of investing, I want to make sure we don't forget the purpose. Okay. Because the purpose is not the levels, right? The purpose is not the levels. And what I mean by that is the purpose themselves, right? Are just merely steps. These levels are merely steps, but we're focusing on gaining greater financial freedom. When somebody becomes financially free, they have passive income that exceeds their savings, expenses, and taxes. They don't have to trade time for money anymore, right? They don't have to, work for a living. They can actually like unplug from the 40-hour a week, life sentence, and they can actually go live life the way they want to. So we want to get here. And the way that we get here is we get to these different levels of being an investor. It's not we get to these levels of being a different investor first, and then we forego financial freedom. These should actually exude financial freedom. They should exemplify, magnify, and create greater financial freedom in our lives as a byproduct of actually getting there. So what are these levels, right? I'm going to go over these here. The first one, I'm actually draw this out as a quadrant. The first one is called a qualified investor. Okay, the second one is called a sophisticated investor. Third one is accredited investor. This is the one everyone knows about. And then the fourth one is called a qualified purchaser. This is one that most people have never heard of. And I'm going to talk about what each of these mean and what they do for us and how we can get there. Now, the very first one is the qualified investor. When I'm a qualified investor, that means that I can start investing in something called a private placement investment at a very low gradient, the very beginning level, right? So when I'm not qualified, that means that, I don't have the education, I don't have the financial means, I don't have the behavior, I don't have the know-how, I don't have maybe the financial foundation to start investing in some of these different private deals that we talk about. And now a private placement investment, this is basically a private deal. Okay, you think about investing, you think about Wall Street. Wall Street, they sell a retail product, it's open to everyone. A private placement is not open to everyone. It means that some wealthy individuals that know how to put deals together got together with their friends. All of their friends are usually accredited. And they said, hey, we're going to put together a fund and we're going to raise private capital and we're going to have everybody put money into this fund, right? And so basically with this fund, we're not going to let the average Joe in. We don't want, the guy putting $50 a month into his mutual fund. We don't want the average family in this deal. We want only wealthy people. And it's almost like a private club for investing, right? Now, as a qualified investor, some of these funds will let this individual start investing. Okay, they're usually very entry level. You have to think about the roles here. The guys that built the fund, they're usually accredited, which means they have $1 million net worth. And so what they're looking at is okay, this fund can be profitable for everybody. This investment can be profitable for everybody, but we also want to manage our risk. And in their opinion, in their viewpoint, and it's not fair, but it's the way they look at it, letting little guys in the deal is risky. Okay, because the guy that puts, 15 grand in the deal and it's everything he's got in the bank, and then all of a sudden COVID-19 happens and he wants his money out and he didn't realize it's a 5-year deal and he can't get his money out. Now he wants to sue the fund, right? And so they're trying to keep that type of individual out. And so the qualified investor, this is somebody that has a minimum of $50,000 to invest. Okay, they've got minimum of 50 grand to invest, right? Now, the other thing, and this is what we build into it, because the regulators for this type of deal, they're very gray. Okay, they make the rules very gray because they don't want to put a bunch of black and whites out there. They want it to be a blanket thing, and then they can come in and get you on whatever. And so what we do is we make it very specific, right? So this person's got to have $50,000 invested. They have to have 6 months in reserves. They have to be consumer debt free. They need to be properly protected against liabilities. Right, liabilities and risks. They need to be cash flow positive. And they need to have held investments. I'm going to talk about what that means. Right? So why would I say that this is the qualification here? Think about this. I'm Jerry Fetta, brand new investor, never put money in a deal before. And I go to one of these accredited guys and I'm like, hey, I want to put money in your fund, right? First thing they're going to say is they're going to say, how much money do you have? If I tell them 5 grand, they're going to be like, dude, we can't buy anything with 5 grand. So the minimum is 50,000. And the reason why that's the minimum to invest is if you think about a real estate deal, whether it's a apartment complex, a mobile home park, a single family home, a duplex, a triplex. If you take the deal and you divide the total price of the deal by the number of units in the deal, you're never going to see less than 50,000, right? So if I have a fourplex and it's got 4 units and that fourplex is selling for $400,000, that means it's $100,000 per unit. That's even higher, right? Now, if I have a mobile home park, that's a little bit different. That might be $50,000 per unit. So this is often the minimum that we're going to see. And so this qualified investor has to have 50 grand ready to go, ready to invest. Now, why 6 months in reserves? Okay, 6 months in reserves because this deal is not a payday loan. What I mean by that is when I put money in this deal, these are typically going to be 5 to 10 years. I need to be prepared to have my money out of mind, out of sight, out of control for 5 to 10 years. Sure, it's going to cash flow. Sure, it's going to pay me every month. But the 50 that I put in there, I can't have that back till the 5 years is done, right? And so it's important that this person has reserves other than what they're putting in the deal so that they're not, trying to rock the boat, flip things over and grab their money out just because they lost their job or they had an injury or a medical incident came up or whatever happened in life where they need cash and the only cash they can see is what they've put in the deal, right? This is protection for the fund itself. Okay. And it's also protection for the investor because if you act this way in the private world, you will never get into another deal, right? It's almost like a credit score. If you're, somebody that tries to get in a private deal and you sign a letter of intent and then you cancel, that's called a DFT or a deal fall through. That's going to show up next time you try and do a private deal. They're going to say, hey, this person DFTs on deals. We don't want them in our fund anymore. Right. Or if you're the guy that puts in 5 grand, 10 grand, 15 grand, and then tries to pull your money out early, they might give it to you, but you're never going to get back into a deal ever again. They're going to say, hey, this person asks for their money back prior to when the term length is up, right? So 6 months reserves. The other one is consumer debt free. Why do we say consumer debt free? This is a simple math equation, right? If I have $50,000 and I put that into a deal, and that deal is yielding me a 12% annual rate, this means that I'm going to make $500 per month, right? Now, if I look at this from the standpoint of, let's say I had $50,000 in credit card debt, right? $50,000 in credit card debt with a minimum payment of 2% of the balance means that I'm going to be paying $1,000 a month in credit cards, right? So if I spend $50,000 on a deal, it's going to make me $500. But if I spend $50,000 on paying off my credit cards, it's going to make me $1,000. $1,000 is more than 500. You guys get my math there, right? So we're not going to put money in a deal when we can actually make more just by paying off our debt. Same thing with a car loan. If I have 50,000 in a car loan, usually going to be 1 to 2% of the balance, if not more. So I'm still looking at maybe a $700 to $1,000 a month car payment, right? So pay off the car, self-finance it with my sacred account. So that's why we say debt free. Now, the other part here, and this is the one that most people like to ignore and hope that they can get by with, is properly protected. Okay, liabilities and risks. What does that mean? That means that I have health insurance, right? That means that I have disability insurance. That means that I have an LLC or an entity if I need one. That means that I have life insurance coverage if I need it. All of this stuff is stuff that I need to have in my life and covered because of something called counterparty risk. Okay, counterparty risk means the risk that another party brings into the deal just by being the other party in the deal. These funds, again, don't want counterparty risk. So when they look at me and they say, okay, Jerry doesn't have health insurance, that means there's counterparty risk. If Jerry has a major medical incident, he's probably going to try and come get his 50 grand out early, right? They don't want that. Jerry doesn't have disability insurance. That means if Jerry gets disabled, he's probably going to try and get his money back because this $500 a month he's making is not going to pay his bills anymore, right? Jerry does not have a limited liability company, right? So we want to make sure he has that first, because that means that there's a corporate veil. If Jerry's company gets sued, we don't want them coming after his assets or the fund as well. So these are all things that we cover in being properly protected. Next is cash flow positive, right? This one defends against something I call IWB. It's kind of like a DUI or a DWI. It's investing while broke. Okay. Investing while broke. The problem with investing while broke is any return looks good because you have no money in the first place, right? Investing while broke means that I've got $1,000 in the bank and I put it all into a digital wallet and buy Dogecoin because I think it's going to turn into $3,000. And that seems like a lot of money for me, right? That's called investing while broke. Broke people shouldn't invest. Okay. Get solvent, get stable, get some assets, then invest. And what happens is when you are cash flow positive, there's no risk that you're, upside down every month and you're trying to pay your bills with this deal. The entire point of investing is to initially at the qualified level, get you enough income where you can save 40%. On your own income, you should be able to save 10 to 20%. That's a given. Anyone should be able to do that if you have a budget, you earn good income, you practice the behavior and you implement the knowledge of wealth dynamics. You should be able to save 10 to 20% on your own. Now, the rest of it, you're going to have to get from increases. So when you do a deal, that extra $500 a month, that should all get saved. And the next one should all get saved. And the next one should all get saved. And it should never be something that I'm paying my bills with, because then it's robbing from my financial freedom. And so if I'm not cash flow positive, that's going to be a factor. Now, the final one on the qualified investor is that they've held investments before. Okay. You're not going to do a qualified private placement deal if you've never done a deal of any sort before. That's why we tell people own gold first. Okay. The reason why is it's tangible. You can practice buying an asset and hanging on to it for 5 years or more. That's why I tell people, if you don't have 5 years, don't even buy gold and silver, right? But buying gold and silver first, it means that I can actually practice. I can get an asset and say, okay, I'm going to hold on to this for the next 5 years. I'm going to wait for it to appreciate. I'm going to follow a plan. I'm going to show discipline. I'm going to show restraint, because those are the things that's going to take in a deal. That's why we tell people also put money in life insurance. Okay, there's tons of reasons and benefits, and it's better than the bank, and it's going to be your own sacred account and all this stuff. But it's also a form of you putting money into a vehicle, leaving it there, keeping it there, following the plan, right? So that you're not, trigger happy when you do your first deal because you've never done one before. And you're like, what's going to happen? Do I get my money back yet? I need this. And you're all squirrely and everywhere, right? So it keeps you stable so that you're actually able to hang on to the investment. So that's the qualified investor. Now we have a couple of questions here. I'm going to answer these towards the end, but drop them in the comments. And again, if you're on Zoom, we definitely will go live. The next one here is the sophisticated investor. Sophisticated, right? Sophisticated. It means a couple of things. First off, it means that I have a $250,000 net worth. Now, the net worth does not include the value of my primary residence. The SEC doesn't allow it. They don't consider it to be an asset because you live there. It does not count towards your net worth. So this is $50,000 in cash, life insurance, investments, businesses, other assets, right? The other thing is that I have done deals before. I have deal history. I can't tell people I'm sophisticated at something that I've only done twice. Right? Like imagine like apply this to something else. Cause I have people try and skip this one a lot. They're like, I want to skip the sophisticated one and just go straight to accredited. Imagine boarding a plane, getting on the airplane, and then the pilot telling you he's sophisticated. Don't worry about it. The flight's going to be great. This is his second flight. You would be a little bit worried, right? Because that's not enough experience. And this is the thing that we're looking for is experience dictates sophistication. So I should be able to show enough deal flow, whether that's 3 or 5 or 7 deals in the qualified realm to say, hey, yeah, I'm sophisticated. I've done these before. I don't need you to walk me through the contract. I don't need you to hold my hand. I don't need you to, I can actually look at a deal and understand what it says because I've done them before. Okay. Now, the other one here is they're saving 40% of their income. Okay, if someone's not yet saving 40% of their income, that means that something is out and they're still not beyond the qualified status, right? Qualified, you should get qualified and then invest until you can save 40% of the income. That's one of the things that we do to get sophisticated, right? And so these are the main factors that we're looking at here for someone to be sophisticated is really just these 3. Now, the net worth requirement is important. That's going to be something that the SEC wants to see. And as we're accredited, we're going to clock in by net worth as well. And so if I'm trying to say, hey, I'm a sophisticated investor and yada, 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 but I've got no net worth, it's not going to fly. Deal experience, we kind of talked about that. 40% savings rate. When we're sophisticated, there is something that's going to change, right? So when we're qualified, we're investing for yield, AKA income. And the reason why is we want to save that income until we can save 40% of our gross. Right? Now, once we've saved 40% of our gross, we then want to invest for something called a compounding annual growth rate, CAGR. Now, yield, the way that yield works is you earn $1, you earn $1, you earn $1, you earn $1, and it accumulates over time. And when you build up enough of these dollars, you can reinvest, right? And then you can earn even more dollars and you can build them up over time. And it's an accumulation game. It does not compound. Okay, this is what nobody likes to tell you about cash flow. Cash flow does not compound. Okay, nothing wrong with cash flow, but these being our reinvestment periods, these being our intervals of time that we have to wait, that can take a while to build up and actually become accredited doing it that way. And so compounding annual growth rate looks like this. Earn $1, reinvest, earn $1, reinvest, earn the dollar, reinvest. And it actually allows you to reinvest in shorter intervals and actually compound on a monthly basis, right? And so by doing this, you can actually grow your net worth higher because the entire goal of sophistication is to become accredited, right? And so we want to speed up the amount of time it takes to become accredited. And by doing this sophisticated investor route, building the net worth, growing it with compounding annual growth rate, this is something that we're able to get to that $1 million net worth much sooner. Okay. And so in this realm, when we're doing the qualified stuff, this is like private lending deals. This is one of my favorite ways to go is private lending. When we're sophisticated, we're doing things like life settlements, depending on the availability. Sometimes these aren't available. We're doing things like Forex. Okay. We're doing things like corporate funding. We're doing things like trade line leasing, right? And so these are all things that are going to grow our net worth faster and multiply so that we can become accredited sooner. And so the purpose of becoming sophisticated is to lay a foundation to become accredited. Okay. Now, accredited is not the end goal. This is the thing that I want to stress tonight because people get so fixated on this. The goal is not become accredited investor. That's not wealthy. Okay. Accredited means I have $1 million net worth. I hit that when I was, I believe, 26 years old. Maybe I was by no means wealthy. I still had months where I was terrified because yeah, my net worth was high, but it doesn't mean that I had passive income. It doesn't mean that I had monthly passive income that exceeded my expenses, savings, and taxes. And so I was still reliant upon selling and earning and selling and earning. And that can be up and down and up and down. And that can cause uncertainty. And so with the accredited investor, this opens up new deal flow, right? And so we want to have $1 million net worth here. And we also have to have completed all prior steps. Okay, I told someone the other day, we do not skip steps for any reason. So when I tell someone, hey, I've got $1 million net worth, I'm accredited, I want to start investing in some of these different deals. Here's what happens, right? So in 1933, the Securities Exchange Law, the Securities Exchange Act came out, which was totally built by lobbyists and Wall Street and banks for their interest. But that's a different story. But that act basically said there are registered investments, retail, mainstream, mutual funds. Those are under the nose of Wall Street. Those are something anyone can buy. If you sell them, you have to have a license. And then there's non-regulated investments, also known as private placement investments. Now, some of these non-regulated investments are reserved only for accredited investors. Okay, only for accredited investors. And when you get to the accredited status, some of the investments are freaking crazy. Now, I can't go into detail, but I'm going to tell you just a scenario, just a story, so I can illustrate this for you. Have a client, he has about $2 million worth of real estate. Okay, and he comes to me and says, Jerry, I want to sell the real estate because the real estate is not passive. Okay, unlike what I thought would happen, I am a manager. I have to manage my tenants. I have to manage rent. I have to manage repairs. I have to manage maintenance, improvements, taxes, regulations. It is not passive to own the real estate. So I want to sell the real estate. And I told him, okay, great. Well, when you sell the real estate, what is your profit going to be? And he said, well, I'm going to sell it for $2 million. My profit is going to be about $850,000. Okay. That means he's going to have to pay taxes on $850,000, right? Any ordinary person in that scenario, they're probably going to pay close to $200,000 in taxes on that sale. That stings. You sell a $2 million property, you pay $200,000 in taxes. Imagine, what that $200,000 could do if he kept it. So since he's accredited, we put together a deal where he's going to take the entire $850,000. He's going to put it into this deal. It's going to pay him a 6% tax-free dividend every single year for 10 years. At 10 years, it's going to cash him out at $2.5 million tax-free, right? We talked about compounding annual growth rate. The compounding annual growth rate on this deal, and this is not a guarantee of anything, but it was projected 17 to 23% annually. Okay, and this is not stocks. So this is not like depending on the market. It's like, no. This is a deal that pays you this much money. This is what we're expecting for this deal to do. It has nothing to do with stocks and markets or any of that stuff, right? So he's gonna avoid all of the capital gains on his sale. He's gonna put that money into the deal. It's gonna pay him tax-free income for 10 years, and then on year 10, it's gonna give him a $2.5 million tax-free cash out. Okay, that's ridiculous. This is the kind of stuff that most of you guys don't even realize exists. Like we see on the news, these people that are angry at the wealthy and they're saying people don't pay their taxes. Bro, they don't even know the half of it. Could you imagine the riots and mobs and craziness that would be going on if the average American just heard what I said? That a guy with $2 million in sale proceeds doesn't want to pay 10% on his total taxes on that deal. And so he's going to do this instead and pay nothing. Right? That's definitely not your fair share. And so when you're accredited, you don't have to do your fair share. You can do these different deals totally, essentially confidential until you're accredited. So I can't tell you any more than what I've told you. But as you can hear by the description, these are amazing and they're incredible. And it's something you should get to. Now, again, this is not the end goal. Okay, this speeds you up to become financially free. Because somewhere between here, let me just make a little bit of space here. Somewhere between here and the qualified purchaser, the average person watching this is going to become financially free somewhere here, right? We'll call this financially free. Accredited is $1 million. You're definitely not financially free when you have $1 million. You definitely are free when it comes to an investment and you're not held back and you can do all these different deals. Qualified purchaser, which is next, is a $5 million corporate asset base. Right. And I don't think the average person here needs $5 million to be financially free. I think the average person here needs $2 to $3 million invested correctly to be financially free. Okay. And that might sound like a lot, but I think everyone can do that in their lifetime. And I think it can be done quicker than we think. So we're going to become financially free basically at the midway point right here. And at this point, we have PI greater than set. We don't have to trade time for money anymore. We don't have to go to a job anymore. We don't have to work. We don't have the obligation of doing anything ever again other than what we want to do, right? And so here we can actually become a professional investor. We can start a company or a corporation to invest. Now, the thing here with the qualified purchaser is this allows me to set up a corporation or a trust and invest within that corporation or trust. Here as an accredited investor, I can't do that. I have to invest as me, the individual, right? There's this quote from the wealthy, own nothing, control everything. Well, as an accredited investor, I have to own everything. I'm legally not allowed to invest in these accredited deals through an LLC or through a corporation or through a trust. I have to do it as my own person, right? Now, as a qualified purchaser, if I have $5 million in assets and that's inside of the corporation or that's inside of the trust, I can now do the deals as the trust or the corporation. Anyone that knows anything about corporate law, trust law, if you set it up correctly, there's something called a corporate veil of protection, meaning that the government literally looks at the corporation as a different individual, a different person than me, right? And so that takes a lot of risk off of me individually because none of my deals are attached to my social security number, my personal background. And so if something goes wrong, I have a lot of protection because there's that veil there, right? So that only exists at the qualified purchaser level, which is great because as a financially free person, I want to be free, not just from having to trade time for money, but free from liability, right? Now, the other thing that happens as a qualified purchaser is I'm able to invest in different fee structures, meaning that I can start to invest in hedge funds. I can start to invest in deals that might pay me a higher split or a higher return than I would get as an accredited investor or sophisticated or qualified. And so it's just another bump that gets me there, right? But the goal here is financial freedom. And I would say that the financial freedom happens at that midway point. And again, if we go back up to our graph here, right, this gradient scale of financial freedom, PI greater than set is where it definitely starts. But another degree of that is then, okay, I'm a qualified purchaser and I have liability protection against whatever may come up, whether it's lawsuits or it's estate planning or whatever it might be, because there's still stuff down the road that can try and impede or take away my financial freedom. Okay. Whether that's a triggered happy lawsuit guy that wants to sue me over something that wasn't my fault or wasn't even valid or it was frivolous, or if it's estate taxes and it's like, hey, you have over X amount of dollars in your net worth. When you die, the government's going to take 40% of what you built. That's why this qualified purchaser status matters, right? Now, the reason why I hit these is statistically speaking, okay, this is not a ding. Statistically speaking, 8 out of 10 people watching this are insolvent, meaning that we're not even at the qualified investor. Okay, and this doesn't mean don't try. This doesn't mean slow down. It doesn't mean any of that. It means that there's all this stuff going on that we can be involved in and that we can be doing, but really we can't because we're up here insolvent. Right? Insolvent means that I don't earn more than I spend. Insolvent means that I have consumer debt. My liabilities exceed my assets. right? Insolvent means that I don't have 6 months of reserves built up. Insolvent means that I don't actually have a forced savings plan of any sort. I don't put money away at all, right? 25% of Americans admit that they don't even have a savings account now. Insolvent means that my liabilities aren't protected. Okay. If I'm up here insolvent, my goal should be to get solvent as fast as possible so that I can become qualified. Right? 8 out of 10 people are insolvent. That means 2 out of 10 people are somewhere on this chart, and we know most of them aren't accredited. They're not usually qualified purchasers. Some of them might be sophisticated. A lot of the 2 out of 10 are probably just qualified, right? And so what happens is we can get stuck. We can get stuck in our current situation because we forget that we can actually make progress, right? So if I'm insolvent, the number one thing that I should be doing right now, I should be disagreeing with insolvency, right? I'm insolvent because of the behavior that I have and the knowledge that I have or don't have, right? That's the thing with knowledge, is sometimes it's knowledge that I lack that's actually dragging me down. But with finances, especially today in the internet and technology age, I find the thing that holds people back with knowledge is the things they do know, right? The stuff that they've been indoctrinated with by Wall Street and the banks, right? Like it's the definition of letting the fox guard the hen coop. These guys are teaching us about money. They're designing our testing curriculums. They're designing our financial licenses. Meanwhile, they're the one cooking up the stuff and selling it, right? And so all roads lead back to them. And so if I'm insolvent, I have to realize I don't have knowledge. Whatever I think I know is completely invalid, because if it was really knowledge, I wouldn't be insolvent. I wouldn't be broke. I would have 6 months in savings. I wouldn't be putting money in the banks. I wouldn't have consumer debt. I would actually have real assets. I wouldn't be, shying away from protecting all my bases, trying to hang on to every last dollar I earn because I don't have a strategy, right? So my goal should be get here as fast as possible and get out of insolvency. Okay. And that's something we help people do. If I'm qualified, that's great. And when I'm qualified, the thing that I see that slows people the most down on qualified is they do their first deal and then they wait so long before they do the next deal. Okay, the reason why I'm 29 years old, in 6 months, I'll be financially free, meaning that I'll be here, passive income greater than savings, expenses, and taxes. The reason why is because I do not slow down when I invest. Okay, COVID happened. I did like 6 deals. I wasn't like, oh, let me wait and see what the economy is going to do and what the Fed's going to do and what the interest rates and the hyperinflation and this. No, that's all crap. Like, I can't control any of that. None of that matters. I have a target. My target is financial freedom. The only way I get there is by doing the next deal and doing it as fast as I possibly can. And if I'm not doing that, that means that there's probably knowledge and behavior that I haven't addressed that I should have. Just a second. There's probably knowledge and behavior that I haven't addressed that I should have that's holding me back, right? And so this is something that all of us should really focus on and pay attention to. Now, the other thing that I see on the sophisticated, this is the next holding pattern that I see here, is people get to sophisticated and then they get lost and confused because there's all these new shiny objects, life settlements and credit and Forex and this and that. And then they start looking at all of the shiny things. They're like, oh, what about Bitcoin? What about Dogecoin? What about, AMC stock? What about this thing? What about tax liens? What about syndications? And they start trying to get into all these weird things, right? And so this is something where the sophisticated, we already have this route cut out for you. It's already lined up. It's already ready to go. And so all you've got to do is follow the path to become accredited. Okay, this is not the time to go looking through the orchard at interesting things that we found. This is the time to get to the next step as fast as possible, right? And then on accredited, a lot of people don't get here. And the ones that do, usually they're satisfied, they're happy, and then they're just like, well, let me start dabbling. And this is what I see that holds the accredited investor back, is they start dabbling. They're like, yeah, send me 12 different PPMs and I want to look at all of them and I'm going to be indecisive about all of it. I'm going to take my time. And they forgot the things that got them to accredited in the first place, right? And so when someone's accredited, the thing that I would say that holds them back is sitting on their laurels and starting to implement new practices that they didn't implement to get there, right? If I did X, Y, and Z to become accredited, why would I change that? Why would I change the operating mode that got me there in the first place? Okay. And then with qualified purchasers, usually there's not a lot of holdback there other than, maybe paying some of the costs to set up corporations, trusts, and different things, right? So someone's still in kind of the constricted poverty mentality, hang on to everything. and they're like, hey, we need to spend 20 grand to build a trust. What? Right? And so someone might not be willing to make that investment. Now, the good news is they don't have to become a qualified purchaser. They're financially free already. They could just enjoy that. But that is the next step. And so realizing that for somebody that's financially free, there are still steps after that. Okay, just because I'm financially free, and this is my passion, just because I'm financially free doesn't mean you are, and it doesn't mean the next guy is, and it doesn't mean that my friends are, and it doesn't mean that my family is, and it doesn't mean my staff are, it doesn't mean that all my clients are. And so I can teach people now how to do what I did, how to get where I got. I can help them up to the top of the mountain. And so when I'm financially free, I think the thing that holds people back, the holding pattern there is, I'm done. I hit the finish line. I can stop now, right? There's not another thing. There's not a next level. Now, after qualified purchaser, there's still 5 or 10 other things we're going to do. We're not going to talk about them tonight, but I want to point this out so that you know that it doesn't just stop here. Again, back to our main point of focus. This is a gradient scale. And so I'm going to continually achieve greater and greater financial freedom in life. And if I don't purposely do that, inflation, taxes, government regulation, globalism, socialism, all this stuff is going to continually try and give me lesser and lesser financial freedom. And so I have to actually impact my finances in a way that outgrow and out earn these eroding factors. Otherwise, I will go backwards. Okay, you can study every wealthy family in history, right? You look at the Vanderbilts, one of the wealthiest families at the time in the late 1800s. Today, I'm not going to say they're broke, but they don't have very much money left. Right? You look at the Rockefellers, they actually achieved greater and greater financial freedom, mostly due to the things that Rockefeller did with his entity structuring. Right? So there's a lot that we could cover here, but what I'm going to do is I'm going to wrap up for tonight. I want to answer some questions, and I know that we covered a lot. And so if you have questions on anything we went over tonight, drop them in the comments. I'd love to hear your feedback. If you have questions on what level you're on, how to get to the next one, maybe this is all brand new to you. Never heard of any of this stuff before, and you're like, hey, this is Greek for me. I want to answer that as well. All right, good to see everyone. Tyler, good to see you. Jazwan, good to see you. All right, Tyler has a good question. Tyler asks, is there still risk to accredited investors, to accredited investments? What makes it more secure than investing money in stocks in a company that's been around for a long time and has a good track record? That's a very good question. Now, kind of two questions there. With accredited investments, there are risks, right? Every investment has risk. It's the nature of investing, risk to potentially lose money, not make money, have lower returns than I thought I would have. Maybe there's legal repercussions on certain investments. There's always going to be risks. And so accredited investing does not get you out of the risk category. It gets you into different types of deals, right? Now, the other part of this question is what makes accredited investing better than investing in the stock market? Why not buy blue chip stocks, the Walmarts, the Disneys, the Home Depots, the companies that have been around for 50, 60 years. They pay a good dividend, right? And here's the thing. Stocks are paper assets, right? Which means that when a company, let's start here. When a company issues stock, they're doing so out of lack. They're saying, we want to expand. We don't have enough money to do so. And so we're going to sell invisible shares to shareholders, right? Now, the problem with this is with stock, there's no downside protection. Okay, if a company goes insolvent, I've got absolutely no protection as a common stockholder. I just lose my ass and I'm done, right? Happens all the time. And so in my world, if a company said, hey, we want to expand, we don't have money to do so, I would say, great, I will give you a secured loan, meaning you're gonna borrow my money. And if you don't pay it back, I'm going to take your stuff away, right? And any company that's willing to bet on themselves and they know that they're successful, they would make that bet because they'd be like, hey, we're never going to default. So yeah, we're never going to have to give you our stuff. We'll pay the loan off and it'll be fine, right? A stock offering comes from a place of, I don't actually have the confidence that we're going to be able to pay you back. We don't want to have the obligation to have to pay you back. In fact, we don't want to have the obligation to have to pay you anything. With a stock, the only guarantee is fees, right? The dividend isn't guaranteed, right? If you look at the growth, there's no guarantee on the growth, right? And so we look at these things and we're like, hey, they don't have to pay us any dividend. They don't have to pay us any growth. They don't have to give us our principal back if they lose all of our money. What are we actually getting? Ownership. Ownership of what? Can I go in there? Can I vote? Sure, I can vote and they're not going to listen to me. Can I go in there and hire people? Can I fire people? Are the assets in the company mine? No, they're not. Okay, I have a piece of paper. We're running low on battery here. I have a piece of paper that says I own something, but I don't actually own it. And so that's really what I have to understand with stock. Let me see what our next question here is. I'm going to do a real quick battery call. Hey, Lexi, the battery is about to die. If you can, if you can come help me out here. Okay. Todd says loves the new studio. Like the old days, missing the suit. We're in Florida, boy. You don't wear suits down here. That's way too hot. It's on the iPhone. Yeah, it's plugged in, so I don't know why it's doing that. Jazwan has a question. He says, does buying my house on a HELOC and car outright count as deals to go from qualified investor to sophisticated investor? Or do I need to have 5 to 6 passive income producing deals, adding versus multiplying, which is what I'd like to do as a sophisticated investor? I've already been saving 40% of my income for over 2 years, albeit not in gold or life insurance. I have about $250,000 in cash assets. Awesome. So just one is saying, you know, when you're qualified, are the car and the house things that can get you to sophisticated? They're not going to count, right? So and not to say they're bad things. So one of the first investments that people should make is self-financing their own car. Okay, I think that's an excellent first investment because most people need a car, and that's a great way to go about it using life insurance. The HELOC, great way to own your own house, right? If you want to pay less money than renting and leverage the equity in the house for passive income and have it pay for itself, that's a phenomenal way to go about it. Now, as a sophisticated investor, when you look at your first private placement memorandum and they ask you, are you a sophisticated investor? And you clear up the word sophisticated, meaning that you have great real world experience and extensive knowledge and background in something, you can't honestly check yes to that question. And so even if you're sophisticated by net worth, by investment experience, that's not the case. And so with someone like this, I would say, hey, let's have you do 3 or 4 or 5 qualified deals. And it's not a hard and firm answer on how many you have to do. Okay. That's up to you. And I want you to realize the purpose and the end result. And so the purpose and the end result is to actually get you to a point of true sophistication. And true sophistication would be measured in confidence, competence, and experience. And so that's where we do as many deals as it takes for you to feel like you're in that spot. Now, the great news is qualified deals aren't a punishment. They're paying you 8 to 12% in passive income, right? You want to have that. That's actually a good thing. And so it still will build up and it still will help you in the long run. And if you're earning the way I know you're earning, you're going to get to sophisticated quickly anyways, because if you're saving 40% of your income, you've already got cash assets put away. We can put some of that to work. And then we can start also stacking in more income to get to the next deal that much faster. Excellent question, Jazwan. Man, I love the questions thing. Again, if you guys have these questions, drop them in the comments. All right, we have a question on syndications. Let me go ahead and answer this question here. All right, so I'm going to switch my mic over. We're going to go live for a little bit and answer some of our Zoom questions. How do we turn that down? We're working out a few technical details. I'm gonna just go live on the feed here, and it looks like this question is from Mark Perry. So let me go ahead and add Mark in. And it doesn't look like Mark is still with us. So let me go ahead and answer Mark's question just the old school way. So Mark says, where do syndications come into play? Now, syndications technically are private placement deals. The problem with syndications are usually they fly under the radar. And there are oftentimes people that have never actually done deals themselves, and they're just starting to raise money as a private investor when they've got no experience. So I don't do syndications. I don't, invest with the neighborhood community realtor who's got 5 years experience selling homes, and all of a sudden he thinks he can raise money for, a 20-plex. I think that's a great way to lose money and get burned. So syndications, that's basically when a deal maker puts together a pool of investors, takes their capital, and then buys an asset. And it's very similar to private placements. The difference being private placements, these are actual funds. That's all they do for a living, and that's what their track record is. So I find a lot of syndications, it's the Wild West. Like I said, fly under the radar. Oftentimes they don't have their federal registrations, which means what they're doing is technically illegal. They don't have escrow. They don't have, legal repercussions in place if they default or don't pay investors. They don't have a track record. And so I stay far away from syndications for that reason. When I do a deal, I want to make sure that I really am doing a deal with the right people. All right, question from Vanessa. Let me bring Vanessa on live here. Shout out, by the way, to Vanessa. She completed her Sacred Account certification, which is a gigantic deal. All right, so we're live with Vanessa. Can you hear me, Vanessa?
Yes, I can hear you. Can you hear me?
I can. I've got a little bit of feedback here. Let me see if I can fix this feedback loop. Go ahead and ask your question, though.
How about now?
Much better.
Okay, cool. So my question was, and this comes from like a lot of people posting about Forex and stuff. I haven't really gotten into it or anything like that, but I heard you say that whenever you hit a sophisticated investor, that's when you should start looking at Forex. And so I just wanted to get clarity on that.
Yeah, absolutely. So Vanessa's totally right. Probably since 2016 or 17, Forex has been really popular on social media. We started seeing these bots come out that are basically AI based, and they trade for you. And there's all these different, I even saw multi-level marketing with Forex. So very interesting stuff. Now, the problem is with Forex is extremely risky. And the markets that are in Forex, I think it's a $5 trillion daily market, which means it's the biggest market in the world, bigger than the stock market, bigger than the bond market. And the number two players, the top two players in that market are central banks and hedge funds, right? And so I relate this to swimming in the ocean. And so like doing Forex is like swimming in the ocean. The ocean is full of sharks and it's full of tides, right? And so if I'm inexperienced with being, in the ocean and in something that's that deep, like low tide can come out and I can be beached and stuck on the rocks because I didn't have enough to actually get out in the deep water where I needed to be. And so that's kind of like investing with a smaller amount like that. The other thing is these larger funds, the banks, hedge funds, the market makers out there, they'll actually manipulate the market against these smaller Forex investors. And so meaning like when I go onto a Forex bot or a Forex platform, a lot of them will actually sell my trade history to hedge funds so that the hedge funds can directly bet against me without me knowing it. Okay. So there's a lot there. It's a great investment. Banks invest in Forex. I invest in Forex, but the way to make money in it is you actually hire a professional trader. And so when you're sophisticated, there are funds that have professional traders. And so actually it's a real human being who can make logical decisions, study the markets, understand the volatility, avoid the sharks, avoid the market makers. And so like on my Forex investing, I make probably 30 to 40% returns per year very consistently. I've not lost money in it. That's the average 5-year track record. And granted, I'm doing it as an accredited investor. But I don't see people with bots doing that. And so that's something that, is, you can do it. You can do a bot. You can, learn it yourself, all this great stuff. But the best way to do it is to mimic the banks. And that's the way the banks are doing it. All right. Another question here. It looks like from Avery. Let me go ahead and bring Avery on live here. All right. We're live with Avery. How are you tonight, Avery?
Being well, Jerry. How about yourself? Great.
Hey,
call.
I'm great. Thanks for asking. What is your question tonight?
I was going to say great call and congrats on the new studio.
Awesome. Thank you. This is really just my living room, but it looks like a studio.
Nice. So question for this evening is, I'm at the phase where I'm allocating the majority of my capital into gold so we can prepare for our first private lending deal. my question is, what's the best way and frequency to keep track of your portfolio to prepare to use the gold as collateral to get into the first deal or continuous deals afterwards?
Yeah. Are you talking about tracking values? Like how do you track your gold values most effectively?
Correct.
Okay, excellent. Yeah. So this is one that there are apps that do this, but I'm an old school guy. So I set up just a spreadsheet. And so if you open up an Excel or a Google Doc, you can set up a column and just put, your different ounces, whether it's grams, whether that's ounces, 10 ounces, kilos. And then you can set up another cell that has the gold price. And so you would just go in and you would type in the gold price for the day and have that set up on a formula to multiply it against the number of ounces you hold. Right. And so if I have 10 ounces of gold goes up to $1,900 per ounce. That formula is automatically going to spit out at the bottom that I now have $19,000 in bullion value. And so that's how I would track it. There are apps that do it. You don't have to pay for an app. You can just build that in a spreadsheet. And that's usually the best way to go about it. When you do vaulted storage, typically those are going to be vaults that track that price for you. So if you're self-storing, you'll have to do the spreadsheet or the app. If you're vault storing, the vault should actually track that for you. All right, let's see what other questions we have here. What's up, Brian? Avery asks, you follow the bid or ask price? So that's a good question. So on the pricing, you want to go off of the live spot price on the market. Depending on who you sell to, that can be another factor. So if you're selling to a dealer, you're typically going to pay a premium. That's their bid price. And so that's going to be usually slightly lower than spot. Ask price, spot price, meaning that you're going to pay spot. If you sell private market, you usually can get closer to spot, right? And so you want to look at getting as close as you possibly can to spot, if not at spot. And what I mean by that is, like on private market, let's say that Avery is selling his bullion to me. If I go buy that bullion from a dealer, I'm going to pay dealer premiums and retail markups on it. Even if I buy wholesale, there's going to be some kind of markup over spot, versus if Avery sells it to me, he can say, hey, Jerry, I know you're going to pay a certain premium over spot. I'll sell you a private, my bullion, right? It is secondary market. It's used, but it's still pure bullion. And I'll sell it to you for less than that. And so I can get a better deal buying from Avery his private market bullion because I don't have to pay all the markups. Avery can get a better deal selling it to me private market, because if he goes to a big dealer, a JM Bullion, an AppMex, all these guys that people use online, they're typically not going to buy it from him at spot. They're going to say, hey, there's a premium of 1 or 2 or 3% that you're going to pay us for us to buy your bullion from you, right? It's like a used car dealership. You're never going to get the actual value of the car selling it to the dealer. So private market is best. Try and really stick with spot. And these larger bullion shops, like I used to buy from them until I got my own wholesale. They're similar to the Forex trading. They sell your trades. They sell your trades and they sell your personal info. So steer clear, like work with smaller wholesale, retail, private. I try and stay away from these giant websites. Just because the product is me, not the bullion. I'm just the bullion is the bait to get me using their website. All right, let's see what other questions we have here. I think that might honestly cover it. Let me see if we have anything that is left here on Zoom. No, that's it. So guys, that's all we got for tonight. I'm going to wrap up here. If you're just watching this for the first time, we'll be back again next Friday, 10 p.m. Eastern time. We do these every week free. If you have not gotten a copy of my book yet, get one online. It is jerryfetta.com/B2F. This is my book, Blueprint to Financial Freedom. These are the exact steps that I took to gain my financial freedom. I'm 29 years old. I'll be financially free in about 6 months from now, following these steps. They're not mine, by the way. I studied the top 1% of wealth and just wrote down what they did and turned it into an easy to follow plan. So again, you can get this at jerryfetta.com/B2F. That's the letter B, the number 2, the letter F. Make sure that you like, share, and subscribe. If you are watching the replay on this, drop your comments below, drop your questions below. I would love to answer them for you, and I will see you guys next week.